Hey there, everybody. This is Mitch Goldberg. We are live. Welcome to Be the Boss of Your Money live podcast. You like that? That's a new name because I'm taking things in a different direction with this podcast. From now on, it shall be referred to as Be the Boss of Your Money, because that's what this is about. This is all about, I should say, this is for people who are interested in learning about personal finance. And speaking of personal finance, I have a very special guest with me. His name is Warren Goldberg, my brother from another mother. Well, actually, you could guess if we're related or not. And if you guess right, Warren says he'll buy you a drink after the show.
Absolutely.
So let's see how that goes. So I've got a few questions for Warren. Warren is a mortgage specialist with the firm Mortgage Wealth Advisors. He knows a tremendous amount about mortgages. He's been in this industry for your whole adult life, pretty much?
Almost 30 years now.
Almost 30 years. So he knows more about mortgages than probably anyone we can find. And that's the kind of person who I want to have on this channel. So without further ado, okay, what's new for mortgage borrowers in 2020?
Well, first off, thank you, Mitch, for inviting me. It's a pleasure to be on the show. And hello, everyone. What is new in 2020? 2020 promises to be a very good year in real estate. All the statistics are showing that there's going to be more buyers. There's going to be more houses that are coming on the market. The loan sizes have been increased, so it helps people to who are buying homes to keep their loan sizes in the conforming range, which typically means better interest rates. Over the last decade since the crash, guidelines have been swinging back towards center, whereas after the crash, they were way out in the extreme.
So it's overly stringent, too hard to...
It was definitely too hard after the crash in the years following.
To be approved for a mortgage.
Correct.
For many people.
Correct. And they have been coming back towards center over the last couple of years. So that's very gratifying.
Do you see them going past the center back to the crazy days of 2004, 2005, or we still have a ways to go?
Probably not.
We learned our lesson?
Those who, how does the expression go? Those who don't remember history are doomed to repeat it?
Yes.
There have been certain new laws put in place to prevent such things from happening. But, history is cyclical. Things will, go back and forth. They'll get less stringent, more stringent, et cetera.
Okay, one day.
One day.
Now, I've read that millennials who is known as a generation that came of age during the Great Recession, student loan debt. Their baby boomer parents aren't selling their houses, but now baby boomers have entered the housing market in a very big way, where there may be 50% of new home purchases. Do you see that in your work?
The baby boomers are the biggest demographic there is in this country right now.
Millennials.
Millennials.
Okay.
Millennials have surpassed baby boomers.
Correct.
In terms of the largest demographic.
Just, we are Gen Xers. Okay, so if somebody out there wants to say, "Okay, boomer," I tried to explain this to my kids. I'm not a boomer, but after about 3 seconds, they didn't really care. But go on.
Gen Xer means we're getting old.
Okay,
that's about it. So after the crash, there was a huge pent-up demand from the millennials to purchase homes. And after the crash, whether it was because of it was because of the stringent guidelines. There weren't a lot of houses in the market. So this demand has been taking years to be fulfilled. Even now, there are not enough starter homes on the market nationwide for these millennials to purchase.
What should a first-time mortgage borrower do to prepare themselves before they apply for a mortgage?
The biggest misconception out there, or the biggest mistake that people tend to make, is they say, "Gee, I want to buy a home." They go out looking at houses. They find something they love, and then they say, "Oh, by the way, I need to get a mortgage," and then they address the mortgage financing. Mm-hmm. To use a financial analogy,
I love financial analogies.
I thought you would.
I just love them.
You would. Putting
financial analogies and alliterations.
Yes, finding a house and then worrying about the mortgage is like retiring and then thinking about retirement planning. If you're thinking about buying a home, get pre-qualified first. Talk to a professional. Make sure that you can qualify for the type of mortgage, for the amount of mortgage that you're looking to borrow before you start looking. And frankly, even if you can afford, beg your pardon, if you can qualify for a certain size mortgage, doesn't necessarily mean that that is the price range you should be looking in. People are different. People have different expenses, different lifestyles. Not all of this is factored into the equation when getting pre-qualified.
Now, how big are down payments typically these days? Because houses are extraordinarily expensive. That was something that was holding back the millennial generation from acquiring homes, because 20% on a $600,000 house is just a lot of money. $120,000. Where do you see that?
I see a lot of people putting 20% down. Sometimes they are accumulating these funds on their own. Sometimes they're getting gifts from family. I also see a lot of people buying their first homes with only 3% down. So, it runs the gamut. You do not have to have 20% down. And believe it or not, that is still a huge misconception out there.
What are rates these days?
Rates are still low. If
3.5 on a 30?
Yeah. It's funny. Rates are all relative, and people have short memories. When rates are at 3.5, everyone's happy. Then rates go to 4%, and everybody says, "Oh my God, that's so high." Well, talk to your grandparents who remember fixed rate mortgages being 17, 18, 19% back in the 80s. And when you talk about, 3, 4% rates, they'll laugh at you. They're ridiculously low. Fixed rate mortgages were never below 5% until the crash. So it wasn't until 2009 that fixed rate loans were ever below 5%.
Tom, my friend Tom Moran has a question here. Hi guys, great show. With ever increasing state and local taxes, especially on Long Island, what % of a person's income would you recommend someone not exceed when looking to get a mortgage? Okay, so what % of a person's income would you recommend not exceeding? Okay, so
the guidelines stipulate that no more than about 33% of your gross annual income should be used towards housing expenses. Those can be stretched with certain programs up into the 40s even. However, a lot still depends on your lifestyle. If you are, I'm just throwing out numbers, if you're earning $75,000 to $100,000 household income and you're buying a $400,000 or $500,000 house, chances are your ratios are going to be higher.
That's a bit of a stretch.
It's going to be tight, right?
And you're leasing a 7 Series Beamer.
Well, yes, and then you're going overboard.
Yeah.
But then again, if your household income is into the 7 figures and you're buying a 7-figure house, you can probably afford to go into the 50s in terms of a debt to income ratio and still cover everything else. And again, it also depends on where you're living. You're living on Long Island, it's going to be a lot tougher than if you're living in the Carolinas.
Warren.
Yes.
How can people reach you?
Best way, you can go to my website, which is www.mortgagewealthadvisors.com. My email address, wgoldberg@mortgagewealthadvisors.com. You could also use the link on the website to send me an email. And the office phone number, 516-584-7218.
And if you didn't write any of this down, you could just reach out to me, and I will gladly pass along Warren's contact information to you, because he is a really good guy. So the big question of the day is, are we brothers? No, we just happen to have the same last name. We're both about the same age, and we both wear glasses. But other than that, I think that's the
very unique last name. It's hard to believe.
That's the end of it. So I'm going to end this live